Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Today, I'm going to show you how to use your credit to help lower your monthly expenses. Now, I know that sounds like the opposite of what you've been taught traditionally, but the truth is that credit is not inherently good or bad. Credit is simply just a tool. And just like any tool, the results depend on who's using it and how they're using it. So today, I want to walk you through a strategy that a lot of people never think about. I want to show you how some people use credit to lower their monthly expenses, create more breathing room in their budget, and turn a stressful financial situation into something that's easier for them to manage. And we're going to break this down in a way that actually makes sense. So without further ado, let's get right into the video. Whether we like it or not, lenders, banks, landlords, insurance companies, car dealerships, and even some employers may use your credit profile to judge your financial reliability. They're not sitting down with you for hours to hear your life story, and they're not asking about every hardship, emergency, mistake, and every season where you were just trying to survive. They simply are looking at a report. That's the score, the payment history, credit card utilization, your inquiries, your account balances, and your overall risk. That is why credit matters. A strong credit profile will give you options. A weak credit profile can limit your options. And when you don't have options, life can get very expensive. That's why I always say your credit score is not just about getting credit cards, it's about financial leverage. So when we talk about using credit to lower your expenses, we're not talking about using credit emotionally. We're talking about using credit strategically. If you're having any issues with your credit report, I recommend checking out Rising. Now, Rising is an all-in-one credit repair platform that not only gives you access to your credit reports and your scores, it also shows you what may be hurting your credit and helps you take actions with tools like dispute templates and bureau response tracking. Now, I suggest using Rising as your 90-day credit improvement system. It also includes 24 months of rental and utility trade lines. That way you can add 2 years of positive payment history to your credit profile. Right now, you can access your credit report through Rising's $1 7-day trial. There will be a link down in the description. There will also be a clickable link here on screen. Now, with that said, let's paint a real life scenario. In 2026, the national US median household income was $64,220. So let's say your income is $64,000 per year, which is roughly about $5,300 per month. Now, that sounds decent, but after taxes, insurance, deductions, and the cost of living in 2026, that money can disappear very quickly. Now, let's say your normal monthly expenses are around $3,500. That would include your rent, your utilities, car insurance, groceries, gas, your phone bill, subscriptions, and the basics. But on top of that, you also have debt. Maybe it's $25,000 in credit cards, $20,000 in student loans, and let's say another $10,000 in medical bills or old balances. Altogether, you're looking at around $55,000 in debt. And for a lot of people, this isn't some extreme example. This is actually real life. And this is where the pressure starts building. If your basic expenses are around $3,500 per month, but once you add in credit card minimums, student loans, and other debt, your real monthly burden can easily climb up to around $7,000 per month. That's $1,700 more than you bring in every single month. And that is why people feel trapped, because you're not just paying for your life, you're paying for life plus interest, plus minimum payments, plus old financial debt that can still follow you around. So now we see the problem. Your income is tied up in your debt payments and they're eating up your paycheck. Now, most people look at this situation and say, well, I just need to make more money. And yes, making more money can help. I'm never going to say that income doesn't matter, and increasing your income is one of the most powerful things that you can do financially. But here's the problem. A second job or more hours means you're spending more on gas. It may mean that you're eating more out because you don't have time to cook. You may be paying more in taxes, and you may be losing time with your family, and you're also sacrificing your health. And when it's all said and done, the extra money that you're making will slowly trickle down and barely hit that debt. Not to mention, when people work more, they tend to spend more. It's just a natural human reaction because you'll tell yourself that you've been working so hard, you deserve this. So the question is not just how do you simply make more money? The better question is, how do I lower the pressure on my monthly cash flow? Because if you could lower your monthly expenses, then you're able to create some breathing room. And breathing room is powerful because that creates opportunity. This brings us to our strategy, and this is also where credit can become a very powerful tool. Now, let's say that you have a decent credit score, meaning you have around a 680. You don't have any late payments, you have enough credit history to qualify for decent terms, and your income is stable. In this situation, one option you may want to consider is a debt consolidation loan. Now, this comes from a bank or a credit union or even an online lender. Now, some examples that people often look at include companies like SoFi, Lending Club, Lightstream, Upgrade, Best Egg, Prosper, or a local credit union. Now, I'm not endorsing any specific lender here. I'm just giving you some examples of the type of lenders that people may research. Now, I have an entire video on the Lightstream loan and the approval process. I also have videos on SoFi and Navy Federal, just to give you a few other examples. I also have an entire dedicated video to personal loans, and the video is arranged by credit score, starting from excellent to bad credit. So I highly recommend that you check out those videos if you want a more in-depth review with data points included that actually show you what you need to get approved for those loans. However, our goal is very simple. You want to apply for one of these options, and if approved, you would use these funds to pay off higher interest debt. Then, instead of juggling multiple credit card payments, personal loan payments, and random balances, you now have one fixed payment with a fixed term. And the key word here is fixed, because a fixed payment can be easier for you to manage than revolving credit card debt, because you know exactly how much you're going to pay every single month. You know when the loan is scheduled, and you know when the payoff is going to actually be after you complete the terms. Credit cards are different because with credit cards, you keep using the card while only making minimum payments, and the balance can feel like it's never going away. You also have student loan payments and other things that, while you can put them in forbearance and other options like that, it can feel like it's taking forever to pay those off because they keep getting delayed and pushed back. Another problem will be the interest and how that keeps stacking up. And again, it can feel like you'll never actually hit the principal. Now that we know what we're going to do, let's go back to our original example. So you have $55,000 in debt. Your monthly expenses are around $3,500. You make around $64,000 per year. Again, you have decent credit, stable income, and you're able to apply for a personal loan for debt consolidation purposes. Let's say you apply for a $60,000 loan because we want to get just a little bit more. Sometimes lenders don't always approve the full amount requested, so we just went slightly higher. Whatever the case may be, you're approved for $60,000. Your lender will offer you an 84-month term, and that means the loan is scheduled for 7 years. For this example, the interest rate is not going to be nice. It's going to be around 15% APR. And people will hear that and say, I don't want to pay 15% interest rate on a loan. And I understand that reaction. Nobody wants to pay high interest, but you have to compare the interest rate to what you're already paying. For a $60,000 loan over 84 months at 15% APR, the estimated monthly payment would be around $1,157.81 per month. Just by us restructuring this debt, you created cash flow. Because if your current monthly expenses are around $3,500 per month, and when we restructure that debt into one personal loan, again, $1,157.81, you just freed up around $642 per month in cash flow. You're no longer overspending. And if you want to break that down even further, just take $5,300. That is what you make monthly. You would deduct the $3,500 for your monthly expenses, and then deduct the $1,157.81. That's the restructured debt, all in one fixed payment. You actually keep $642.19 per month. Now, that debt did not disappear. You still owe money. The difference is that you took scattered high pressure payments and restructured them into one predictable monthly payment. Now, of course, this is where a lot of people need to be careful. You get approved for a debt consolidation loan, you pay off your credit cards, your utilization may have dropped, which means your credit score will get even higher, and your monthly payments may feel even easier for you to manage. Then you look at your credit cards with a zero balance and start thinking, well, I have available credit again. And that is the danger zone, because if you take out a loan, you pay off debt. And in this example, 25,000 credit card debt. We also had, our various debt for student loans and our medical debt. If you paid off all of this, you do not want to run up those credit cards once again, because we actually did not solve the problem. In that case, we've actually created two more problems now. So you have to remember, no matter how great your financial strategy is, if you don't fix behavior or reckless impulses, then it's going to come back, nothing will change, and you'll stay in the same pattern. And this is why the real credit hack is discipline. People want the secret lender, the secret method, the secret credit union, the secret approval trick. But the biggest secret is not sexy, it's not cool, it's just truly paying on time, keeping utilization low, avoiding unnecessary debt, building income, and not spending money just because you have access to it. That is not exciting, but it does work. Now, let's talk about student loans, because there is one thing I want to go over that is important. Some people consider using personal loans to pay off student loans, but you need to be very careful with that. Federal student loans may have protections that personal loans don't have. Depending on the type of student loan, you may have access to income-driven repayment plans, deferment, forbearance, forgiveness programs, and other protections. And if you use a personal loan to pay off federal student loans, you may lose those benefits. That could be a bad move for some people. So before anybody takes this strategy and runs with it, you need to understand what type of student loans that you actually have. Federal student loans and private student loans are not the same. Your interest rate matters, your repayment plan matters, your career matters, your forgiveness eligibility will matter, and your financial stability matters. So do not just say like, Steven told me to get a personal loan and pay off my student loans. I did not say that. What I'm saying is you need to analyze, do the math, check your protections before you make a decision. Even when it comes to some medical debt, if it is third-party medical debt, you could look at one of my videos for actually removing that debt from your credit profile. In that case, you may not have to pay that back at all, which would then make this process even easier than it already is. So there's a lot of things that you would want to consider. In many situations, consolidating high interest credit cards will make a lot of sense. In other situations, refinancing or paying off other types of debt, in this case, like a student loan or credit card or medical debt, it might make sense. You have to know the difference, and this is where working with a qualified financial professional, it can help, especially if you're dealing with larger balances or federal loan programs or bankruptcy questions or anything that could have long-term consequences. Now, the biggest lesson here is this: credit can give you options. When your credit is bad, you're forced to accept whatever terms that you get. When your credit is strong, you can actually compare options and you can weigh them. And that is why you should care about your credit before you need it. Most people don't care about it until they're in some type of emergency. A good credit profile can help you access better credit cards, lower interest rates, higher limits, better loan terms, and more financial flexibility. And when you combine good credit with good income and good discipline, that's when things start changing. Here's a different way to think about it. Most people only rely on their paycheck. They work, they get paid, taxes come out, bills come out, whatever is left is supposed to cover life. But earned income is expensive because it's taxed before it ever hits your account. You need to understand that earned income is not the same as borrowed money. When you borrow money, that loan is not treated as taxable income because it has to be paid back. That's one reason wealthy people, business owners, and investors often use debt strategically. Wealthy people often use debt to buy assets, to manage cash flow, to expand businesses, and reduce opportunity cost or create leverage. That doesn't mean debt is risk-free. Debt is always a responsibility, but there is a big difference between using debt with a plan and using debt because you want to feel rich. Now, let's say the strategy works and your monthly bills have dropped. What should you do with the extra money? The first thing you should do is build an emergency fund. If you have no emergency fund, you're one inconvenience away from being back in debt. Even a small starter emergency fund can give you some protection, and then over time, you can build 3 to 6 months of expenses depending on your situation. Next, you can make extra payments toward that consolidation loan. Just because you chose a longer term doesn't mean you have to take the entire term to pay it off. Sometimes people choose a longer term to lower the required monthly payments, and then they pay as much extra as they can. That gives them flexibility. If money is tight one month, they can pay the required payment. If money is better next month, they can pay more. But before you do that, check whether or not the loan has a prepayment penalty. You don't want to assume that you can pay it off early without consequences. Make sure you read the terms. After your emergency fund is established, you can always use the extra cash flow to invest, build a business, or put yourself in a better financial position overall. The key is that the money needs to have a job. If you free up $600 per month and that money just disappears into random spending, you just wasted an opportunity. But if you use that $600 to invest, reduce debt faster, and create stability, you can completely change your financial life. Now, some of you may be listening to this and saying, well, this sounds good, but my credit is not where it needs to be. Then that's your first step. If your credit is not in position, you have to work on it. I've given plenty of free resources on this channel, paid and free options. I mean, you can start an account with Rising or pull your credit report from annualcreditreport.com. Go through all three bureaus, look at inaccurate information, and start to dispute it. You also want to focus on the basics. Build positive payment history. Let your credit accounts age. If your profile is thin, consider adding strong primary accounts or responsible authorized user accounts if appropriate. And most importantly, stop ignoring your credit. A lot of people don't have bad credit because they're bad people. They have bad credit because life just happens. They didn't understand the system and they were avoiding the problem for too long. But avoiding a problem doesn't make it better. You need to face it, fix what you can, and rebuild strategically. Because once your credit improves, your options will improve as well. I want to thank you guys so much for watching this video. The biggest lesson is this: credit is not just about borrowing money. Credit is about positioning. When you're financially positioned, you can make moves from a place of strategy instead of desperation. So if you're in a situation where your paycheck is getting destroyed every month by debt payments, don't panic. Sit down, look at your numbers, pull your credit reports, understand your options, and create a real plan. And if your credit is not where it needs to be, then start there. But remember, credit is only a tool. You are the strategy. So before you go out and apply for anything, make sure the math will make sense, make sure the payments are affordable, and make sure you have the discipline to handle this accordingly. If this video gave you value, please make sure that you subscribe to the channel and drop a comment below and let me know what strategy that you've used to lower your debt faster. And as always, I appreciate you guys so much for watching this video. I truly do. Thank you so much, and you have a wonderful day.